here's the rules for the fib retracements and the extensions. I'm just going to give you the most common ones. This is going to account for probably 3/4 of the fib moves you see out there. So they're the good ones to start with. Whenever you see 38.2, as we saw in that example for the retracement, the extension is going to go to 138.2. Not every time. You still have to watch your indicators. Sometimes you might have to exit early if you see a reversal. But from trading this over several years, I can say about 77% of the time. 38 will go to 138.2. 61.8 goes to 161.8. Pretty easy to remember. And in between those two, if it goes to 50% retracement, it also goes to 161.8. There's a few other ones. You can get them on my website. You can Google Fibonacci and get them on a lot of other websites. But those three are by far the most common ones you're going to see out there. All right? Let me show you some practical examples. This is a 5-minute chart. A lot of people ask me, well, which time frames do fibs work best on? Honestly, all of them. Fibs are based on ratios and percentages. And if you catch the bottom of the move and the top of the move, if the move is bigger, your fibs are going to be wider apart. Yes, sir? Yeah. You basically look at the move prior. I'll answer in mine. He was asking where you measure the move. If you're looking to trade down, or in other words short, then you look to the left of the chart and find the prior down move before that. If you're looking to trade up, or in other words to the long side, then you look left on your chart and find the previous up move. And you always measure from the beginning of the move to the end. So in this one, we're right here. We found support right over here. Looks like we're going to go up. So if I'm looking to long, then I go left and look at the left. Where's my last big move to the upside? And that was here. So I just measured from the bottom up to the top of that move. And here's what, oops. Yep. And that's what it looks like with the fibs. You can see once again we nailed that top almost perfectly. A little bit shy, but you also, same with the pivots. You don't want to put your targets right on the line. Okay, always put it a little bit shy. You have to account for your broker's spread. You have to account for a little bit of volatility in the markets. So if you see here, this is 95.16 for that top. Just to be safe, I put it in at like 95.12 or something. You know, always go a few pips shy. Just to show you it works on any time frame, we went from a 5-minute chart. Here's a monthly chart of the pound dollar. And this works, by the way, I'm using Forex as an example because that's what I trade primarily, but this works on most instruments. Okay? It'll work on stocks, it'll work on oil, just about anything you're trading. Anything that has humans trading it, basically. Fibonacci measures extreme greed and fear. So anything that human beings are trading, probably Fibonacci will work on. Here's a monthly chart. Here's the monthly chart with the fibs applied. Same thing, from the bottom of the move up to the top of the prior move. And you see once again, measure our retracement, and we go up. Look how perfectly, not only did we catch the top of that move, but notice the in-between levels. We also know in-between what support and resistance are. Why is that important? Well, especially on a monthly chart, and this also goes for a weekly chart, daily chart, look how far apart those levels are. Okay? Some of them 1,200 pips, 1,500 pips apart. You can obviously trade from one fib level to another and just get out there. Wait for a break and a retest, then trade the next fib level on to the next one. You don't have to go all the way from 38 to 138, for example. If you're trading smaller time frames, like 5-minute, 30-minute, then yes. But anything like a daily, weekly, or monthly chart, I doubt anybody trades monthly charts in currencies. But if you do, you're perfectly fine just going from one fib level up to the next one. And just to show you, it's not just for Forex, here's gold. Okay, this is a daily chart of gold. Lots of back and forth action. But look, if you plotted fibs, you'd be able to nail each of those terms almost perfectly. In fact, for gold, exactly perfectly. There you wouldn't even have to go short. Most of those terms happen right on the line. But I like to play it safe. I always go a little bit before. Back to the hourly chart, I want to show you the third indicator that I see used commonly by institutional traders out there. This is the 21 and its outer envelopes. 21 moving average, exponential moving average plotted right there, that kind of acts as my center line. It's the equilibrium that price kind of always falls back to. Sometimes it trades below, sometimes it trades above, but inevitably it will always come down to the middle. That's the outer envelopes, parallel to the 21 exponential moving average. Some charting packages might call them channels, others call them envelopes. I always get asked, why don't I use Bollinger Bands? Quite frankly, I met John Bollinger at a conference once, and he doesn't use them. Not for this. So if he's not going to use them, then I'm not going to either. He told me he uses the Bollinger Bands primarily for pricing options, to figure out what the spread would be. For my trading purposes, the straight channel seems to work best. I don't like it when they contract or expand. I just want to know where the extremes are. Basically what you see happening on the chart is the 21 is our center line. The outer envelopes identify our extremes. So if you're looking to get into a trade, for example, based on pivots or based on fibs, you can also overlay this on them. And the two criteria for a trade should be, you want to be on the correct side of the 21. Okay? So if you're below the 21, like on the first part of the chart, don't look to go long. Chances are price will come up, hit the 21, and then reverse back down. Only take longs when you're on the positive side of the 21. That's already going to help you filter out half your trades. And then look and see, are you closer to the 21 or the outer envelope? Okay? If you're right by the outer envelope, chances are the move's going to reverse there. If not right there, it might overshoot it by a little bit, but basically the outer envelope kind of signals the end of the move rather than the beginning. So if you see that you're getting into something late, don't chase it. The closer you are to the outer envelope, the higher your risk on that trade. The closer you are to the 21 moving average, provided you're on the correct side of it, the less risk, the higher probability of success. Okay, now let's throw up our pivot points again. Let's throw our medians up there again, and now you can see a little bit how the system works put together. Okay, how did I know, for example, out of all the medians, that particular, or out of all the pivots and support levels, how did I know the move would come to the end at that one, and not say this one or this one? Well, we certainly encountered support on the way there. You see we had a small bounce up and back down, but how did I know it was this one? Well, gee, that's the same place that it connects with my outer envelope. Anytime you have two or more indicators, I call them clusters, clustering in the same place, watch out, okay? One indicator by itself is kind of a heads up. Two indicators, that's a very strong heads up. Three or more indicators in the same spot, get out, okay? Don't take your chances, get out there. If it continues dropping down even further, you can always enter another trade. But play it safe, get out there wherever you see an intersection. You know, and here it is with the fibs. As if you needed further convincing, the fib is right down there as well. So that's a cluster. A cluster can be two fibs from two different time frames. A cluster can be a fib and a pivot, or a cluster can be an envelope or a moving average crossing in the same place. But whenever you see a cluster, those are the most likely places for reversals to take place.